back to my point, and I don't want to say this stuff isn't accessible to folks that don't have a lot of money, but it does become a lot less practical.
Oh, yeah.
If you go at, you have $1 million, $2 million, $3 million in a few properties, and you're trying to manage them into your 80s so that you can avoid capital gains on them. I mean, it kind of is one of these situations where we say in wealth management, the tax tail is wagging the dog.
Yeah. All right, here we are again, another 2 weeks. Actually, been a relatively quiet 2 weeks, except for the stock market, which we'll get into. But first, I want to introduce everybody to episode 55 of the Money Alchemist Podcast. I'm your host, Ben.
And I'm Brent.
And we're here today to talk about season 2 of Netflix show Beef, which is chock full of all sorts of case study for financial advisors. It's one of the best shows I've seen since Ozark. It's really fun for anybody in finance to kind of get involved into. But what I really like about this season, it's an anthology. So if you haven't seen season 1, which is good, season 2 is its own story, its own plot line and everything. And it's just full of a variety of different financial topics. So I did the hard work. I know you haven't seen it.
Yeah, I don't know when I'm supposed to find time to watch these Netflix series.
Well, I found the time. It was research for the show.
Yeah. Sorry, honey, I'm working.
Yeah. So we just started one episode. We're like, it's new on Netflix. Might as well watch it. Meanwhile, it was like 5 hours later. We're still sitting there.
The only time I have to do anything like that these days is like in the middle of the night. There's only one way I could ever get that done is stay up till 3 a.m.
Yeah. Well, I was very productive on Saturday. So I cranked out my newsletter in the morning, went out in the backyard, I dug up a bunch of, what do you call those things? Honeysuckle roots that I had to do. So it actually was like 3 o'clock when we started it. It's only 8 episodes. Most of the episodes are 30 minutes long. So it's actually very watchable. I think the episode 7 was like 51 minutes, but quite good. Before we dissect certain financial topics, there are 3 in particular we want to talk about. So one is this concept of buy, borrow, die. The other is a 1031 transfer. And then we want to also talk about a little bit of 2 topics, crunched into one. One of the plot lines of the show is this idea of embezzlement.
Oh, gosh.
And there's multiple layers of embezzlement throughout the entire show. But one of the layers is Oscar Isaac, who plays Josh Martin. He's one of the lead guys in the show. Great actor, by the way. He has a joint tenant account with his elderly mother, who actually, I don't want to give away. You'll have to watch the show to find out. But he has a joint account, but he's spending her money.
Yeah.
Which is a form of embezzlement, really, when you think about it. So those are the 3 topics we're going to touch on today. But as we always do, let's go over the events that have transpired. Because it's been a relatively quiet week in terms of like no news has been new news. But there has been a major movement in markets I know you wanted to touch on.
Well, I don't know if no news is a good way of explaining. It's been a whipsaw of news. We were in the Iran war. We had a ceasefire. Supposedly now we're blowing up ships.
My point is, it's not new. It's the
right.
same.
Yeah, as we like to tell clients, the market doesn't price on good or bad. It prices on better or worse.
Yeah.
And if you've been paying attention to the markets, you'll know that we had roughly a 10% sell-off from peak to trough. And really, the trough was the end of March. Mm-hmm. And statistically speaking, that's actually pretty normal. The average drawdown in a given year in the stock market, if you look since like 1980, it's like 14%, something like that. Even though something like 80% of the time, the market's positive on a calendar year basis. So this was normal.
Yeah.
As much as, it always seems like, though, when things are bad and something's going on, it's like this time is different.
The sky's falling.
Yeah. But it's interesting right now because we've literally, as of the end of March, we were down 10%. And here we sit, 3 weeks into April, and we're all of a sudden back at all-time highs.
Yes.
I don't think if you went out on the street and asked somebody what's going on in the stock market right now, they're going to tell you that we're at all-time highs.
Yeah, most people are going to say there's blood in the streets, the economy's doing, well, I shouldn't say most people. I'd say it's probably Probably half and half. It depends on where you stand in the economic spectrum.
Yeah, I just feel like right now is one of those times where, like, if you watch the news and you don't look at your investment portfolio, by the time you actually decide to log into your investment portfolio, you'll actually say, oh, wow, it's not so bad.
Yeah, and it's also dependent on how you look at your finances. If you're looking at your month-end statements, because people still get statements, I'll say most of the people we work with, they just log into their accounts, but there's still a fraction that wait for that statement to come in the mail. And it just so happened that the low, if you look, where's my mouse cursor here, happened like right on March 30th.
So like if you're looking at a monthly statement from the beginning of March to the end of March, this was not a fun month.
Yeah, and since then, which we're not even at the end of April, since then we've had a 12% rip.
Yeah.
So chances are when you look at your next statement, if this rally continues, it's going to be a lot better than it was on the 30th.
And I think this rally was really a function of multiple things. We of course had tensions cool in Iran, but on top of that, at the same time, you had like pension funds, 401ks. It was the end of Q1, and there's just a lot of rebalancing that's happening in the market in the institutional side that when stocks had sold off and bonds had held up, as they do their rebalance, it says what? Buy stocks. Right. And so we basically turned the calendar to Q2, had this massive wave of rebalancing, which then triggered additional institutional buying through hedge funds, which then ended up prompting retail buying. And there you go. 3 weeks later, you're at the highs.
Yeah. Speaking of institutional trading, take a look at this headline by Reuters. JP Morgan profit beats expectations and record trading revenue, strong deal making. I wonder where the record trading revenue came from.
Oh, banks love this kind of volatility in the markets.
When I read this, my first thought was AI-assisted trading.
You think so?
It's hard to see how not. Now, that's not specifically mentioned in this Reuters article, but record trading revenue. So they've made more trading revenue this past quarter than ever.
But that's pretty normal when markets get volatile. These banks are able to take advantage of that volatility through some of the trades that they place, at least in their trading arms.
Yeah. Now that headline is a little misleading because actually the JP Morgan's profits were pretty diverse. So they had, revenue was up 20%, which for a bank is a monster revenue jump. It seemed like that private credit was throwing in a contribution, interest income.
Well,
so it wasn't
here's
just
the thing.
Trading revenue.
This is something that we talked about on our last podcast. It's something we talked about coming into the year, which is that AI had been such a theme of the last few years and had driven so much of this valuation into the Mag 7 and the tech companies. We've definitely seen a bit of an unraveling of that this year. So according to FactSet, as a matter of fact, if you take the Mag 7 ex NVIDIA, their growth rate for calendar year 2026 is expected to be 13.2%, whereas the other 493 stocks in the S&P projected at 15.9. So we're actually on a forward-looking basis now expecting faster growth out of the 493 than out of the Mag 7. Now, it's worth noting they had to take NVIDIA out of that math to make that math work. Turns out with NVIDIA, the Mag 7 growth rate for this full calendar year goes from 13.2% to 24.8%. If that gives you an idea of how quickly NVIDIA's earnings are growing.
Yeah, NVIDIA remains dominant. I think that the fear was that NVIDIA's earnings were going to come under pressure because of competitive pressures. We have yet to see that happen. It seems like NVIDIA is almost has a quasi monopoly, over that space. It's that data center and the whole AI service structure that it's constructed. I don't even understand their full business model. I wish I did, but it seems to me they've got a pretty wide moat, wouldn't you say?
Yeah, well, and now as of recent, what we've seen is NVIDIA is continuing to grow, but the performance has really slowed down of the stock. We've started to see what's called in investing, you kind of call it the picks and shovels. So these are now the companies that supply NVIDIA that are becoming some of the AI darlings.
Yeah, let's see. Year to date, it's up 7%, so it's outperforming the S&P 500. So it's definitely picked up from its low. So what else do we have in the headlines to talk about before we dig into the main topic for the day?
Well, I think interestingly enough, we had talked about international versus U.S. Mm-hmm. Since the beginning of the war, U.S. has actually outperformed international by 4%. So we're seeing, I don't know, a lot of the performance of international versus U.S. last year was on a weaker dollar, and a big difference with this oil market and what's going on in the Strait of Hormuz is kind of protecting the fact that oil is priced in dollars and trying to protect the dollar. So we've seen the dollar strengthen, which has worked against international stocks. As somebody that, maybe it's a recency bias, but my entire life as an investor, U.S. stocks have been dominant.
Yeah.
So it is pretty...
Yeah, I mean, looking at here at the iShares Core MSCI Total International Stock, so this is basically everything but the U.S. It's up year-to-date 10.31% as of now.
Which is better than the U.S.
Correct.
The U.S. is only up 4%, but if you look at that from February,
mm-hmm.
from kind of where the war started, it's actually gone the other way.
Got it. So one interesting observation that I've made is that almost every international market, the major ones, so the FTSE, the Nikkei, let's see what other ones. Those are the only two that I looked at actually, is positive, but the Hang Seng index is down.
Yeah.
So China's struggling. I wonder how much of that has to do with the fact that they were getting a lot of cheap oil from both Venezuela and from Iran. So, and I imagine there's also other issues going on there too. So not all is well in China, at least according to the index performance year to date. So, all right, do you want to talk?
Of course, you chose to talk about a show that I haven't seen on the podcast. So, for full viewer disclosure, there's no way to get any spoiler alerts here because I actually haven't seen this. So you're going to get my true reactions to some of these
Yeah, and that's
strategies.
okay because, as I've said, I've done the hard work. I've watched the show. I highly recommend it. But there are some great actors in there. You've got, I've already mentioned Oscar Isaac. He plays one of the main leads. Josh Martin. Then you got Carey Mulligan. She plays Josh's spouse, and then you've got Kaylee Spaney, who is new. I've never seen her in anything else, but she plays an actress named she plays Ashley Miller, and then Austin Davis, played by Charles Melton, who my wife did appreciate.
But what's the premise of this show?
Yeah, the premise of the show is Oscar Isaac manages. Actually, Josh Martin, who he plays, manages this really high-class, expensive golf club.
Okay.
So where the initiation fee to get in this place is $300,000. So it's for rich people.
Sure.
And you've got these characters that all work there, and they all have these intertwining conflicts with one another. And
beef, so to speak.
Yeah, beef. And then the show just starts out like things are, kind of right, but not exactly right. But then the whole thing just unravels from episode 1 to episode 8. And then, in episode 8, you kind of see where everybody ends up.
And where does the wealth management come in?
Well, first thing is in episode 2 specifically, there is a wealthy patron of the club named Troy. He's played by William Fichtner. I can pull up his, because a lot of people won't know who I'm talking about. Let's see. William Fichtner is this guy. He plays a lot of different. He's kind of like one of these famous. There's a guy
named Troy.
Yeah, a guy named Troy, and they're in the they're playing poker in the bar, and Oscar Isaac is pouring everybody a cup of aged Scotch whiskey, and the topic of his contract comes up because he is under contract to be the GM of this place. And he's worried, am I going to get my contract renewed or not? And he's hearing through the grapevine, through this Troy character, whether or not his paymaster is going to renew his contract. So anyway, they address that topic. I'm not going to get into that because it's not relevant. But then they quickly move on to this rich people talk. Well, at least it's couched as that. And one of the things that's thrown out there is this concept of buy, borrow, die. So one of the friends of Troy asks him, "Hey, who's that accountant you use? I wish I want you to introduce me so I can save some money on taxes. And then it's in the context, they talk about two things. One is the 1031 transfer, which we'll get into next. But the first one I want to touch on is buy, borrow, die. He says, my accountant set up a buy, borrow, die for me. You know, and
that's how
like it was some like rich people's secret thing that, you know, you couldn't just like YouTube out there and find out how.
Buy, borrow, die.
Yeah, his accountant set it up for. He says he bought some sort of like. This is where the show writers. I'm just like, you guys must have consulted ChatGPT on this because it was done poorly. But he says, he bought something like a Monet for. It's like, how do you not know what Monet is? You know. Are you worth that much money where you can afford a $300,000 initiation fee and you don't know, you've never heard of Monet?
What the accountant's idea was to buy this painting?
Yes. So the idea is this. You buy an appreciating asset. In this case, it was a painting painted by Monet. And you put this somewhere. He didn't talk about where. And then you just have some bank lends you money with that painting as collateral.
Sure.
And then you just hold that until
you die.
Till you die. And then when you die, there is a provision in the IRS that you get what's called a step up in basis.
Well, this is where I can jump in, even though I don't know the show.
This is where I want you to jump in, yeah.
So just for listeners' sake, to give a little bit of education here, certain assets, not all assets, but certain account types or asset types get what's called a step up in basis. What's really is not a step up. It's essentially a resetting of the cost basis to whatever it was when the people pass away. Now, I would argue one reason this could be thought of as a wealthy people tactic is that this doesn't apply to retirement accounts.
Correct.
So like your IRA, your 401k, your HSA, and none of those accounts get basis step-ups. As a matter of fact, those accounts can be fairly complex for the people that inherit them and can carry a lot of tax burden over. But that's for another podcast. But for non-retirement assets, so like typically your house, any investments that you hold outside of your retirement accounts, business interests that you have, real estate properties that you have, things like that, if they're not owned in a retirement account, if they're owned in your name, and not in a separate irrevocable trust, then when you pass away, even if let's say you bought Nvidia stock in 2008,
yes,
and you're sitting on millions of dollars of Nvidia stock, it's fully appreciated, and you sell it, just for example's sake, let's say you sell it, you're going to pay capital gains tax on the growth, right? Now, back to your buy, borrow, die strategy, one of the ways that, and I would say, again, is you need assets outside of a retirement account for this. So it's not like for just the uber wealthy, but you have to have some level of money to really do this strategy. But instead of selling the stock, what you can do is you can borrow against the stock. So you can say, hey, I've got $2 million of Nvidia. I want $100,000 to buy XYZ, name a thing. And you can take that $100,000 as a loan against your Nvidia stock.
Well, how would someone get that loan?
Well, you would just go to your brokerage. So like we work with Charles Schwab, like client accounts that we house are at Charles Schwab. So Charles Schwab, actually, they have a whole bank, Schwab Bank, and they will lend against your brokerage account. Now, ideally, you're not borrowing against super concentrated positions, but you can borrow against any appreciated assets that are in that brokerage account. So long as they're liquid, they don't have other issues with them. So like alternatives, for example, illiquid alternatives, you can't borrow against those. But that's besides the point. Point being, if you borrow against said Nvidia stock, going back to our example, as opposed to selling it, guess what? You don't have to pay
taxes,
capital gains tax. So eventually, and this is how it's done. You have these appreciated assets, all sorts of appreciated assets, be it stocks, real estate, whatever it is. They've grown for a number of years, and you need to monetize them. You need to live off of them. So you have an option. You could either sell the asset, pay the taxes, or you could borrow against the asset where you don't pay any taxes, and eventually, when you pass away, any unrealized capital gain still on that asset goes away, and your heirs inherit the money tax-free.
And everybody can do this. The one thing I do want to point out, though, is that it's not cost-free. So there's this notion that, that's just an easy way to dodge taxes. No, it's a alternative.
You do pay an interest rate.
Exactly. It's not free money. And you have to weigh, okay, well, what's higher, paying the taxes or paying the interest to the lender? And for most people, because there's a separate bracket called a capital gains tax bracket, long-term capital gains tax bracket. For a lot of people, you can sell appreciated positions at a pretty low tax rate, maybe 15%, could even be 0%. Those higher capital gains brackets don't really kick in until you're in the higher income brackets.
Well, regardless, the concept here is that as opposed to selling appreciated assets and paying stock, you borrow against them, and then eventually when you pass away, everybody inherits that without having to pay the tax. Buy, borrow, die. But the truth is there are risks to this strategy, okay? So especially if you are, I don't want to pick on the fact that you're like, hey, this is just not only for uber wealthy. I don't know where you draw that line, but certainly you want enough money in your pockets, so to speak, to really be able to employ this. So one of the reasons why, I'll just continue with my NVIDIA example. Let's say you have $2 million of appreciated NVIDIA stock and $2 million of NVIDIA stock will support a loan of, let's say, $1.4 million.
Yes.
So Charles Schwab says, hey, on your $2 million of NVIDIA, we'll lend you up to $1.4 million. Your interest rate, it's normally what's called the SOFR rate.
Yeah, SOFR plus 2 or 3.
Yeah, so SOFR is the overnight funding rate. So SOFR, I think, is like 3 3/4 right now, somewhere in that range. And then they'll add SOFR plus 1 to 3%, something like that.
Yes.
And here's the catch, though, is yes, you can borrow $1.4 million, but if NVIDIA stock goes down, so does the amount that you're allowed to borrow.
Yeah, exactly.
So for our clients, really, we want to make sure they're not getting over leveraged. We want, even though the regulations might let you borrow 70% of the account value, we might encourage clients to keep it to something like 20 to 30% of the account value. Because what actually happens is if you borrow, let's say, $1.4 million on the $2 million, and then NVIDIA stock goes down by 30%, Schwab's going to want some of that money. So you get what's called a margin call. Okay. And this can be really, really dangerous. And you need to make sure that if you're borrowing against these assets, that you have a backup plan for what are you going to do in the case of a margin call. Because if you don't have other money, if Schwab comes and asks for that money and you don't have some other pocket to go get it from and give it to them, guess what they're going to do?
Well, they're gonna call the loan.
They're going to sell your NVIDIA stock.
Yeah. Well, I've actually never seen this forced. What they do is they send a letter.
Oh, they will sell your position.
They will sell
you out of the position to cover their margin loan, and you will pay the taxes on it.
Yeah.
And so you just have to be really, really careful. One of the number one rules to investing is don't ever become a forced seller.
Exactly.
That should be at the top of the list in terms of ways to be a successful investor. Don't become a forced seller. And you just have to be aware that when you're borrowing against these assets, if you don't do it well, you can become a forced seller. And that's just a new risk for somebody that doesn't borrow, doesn't maybe have to think about as much.
Yeah, Dave Ramsey talked about this in his early years. He's famous for saying that he filed bankruptcy in the, I think it was early 2000s. I can't remember exactly. But he took out a lot of real estate loans. And he was pursuing this same exact strategy, maximum leverage. Yeah, people call it OPM.
Yeah,
other people's money. And the idea is this is not a new concept. We just given it a new name: buy, borrow, die. So anyway, Dave Ramsey got out over his skis in leverage, and then the bank started calling his notes.
Yeah.
And then he got into a position where he was forced, because he had no liquidity, he was forced to sell every one of those properties. And when you are in a position where you're forced to sell, you do not get to determine the price.
Yeah, you fire sale it. It's called a fire sale.
Exactly.
Right? You don't want to have to fire sale assets.
Yes. So this whole strategy, it sounds great. Yes, wealthy people do use it.
But there are really good applications to this strategy. So for example, if you have let's say I have a client that has a $5-10 million portfolio that's not a retirement account, that's got a lot of appreciation in it, and it's diversified. There is some pretty good value. I'll give a great example. I've seen a situation where this happens. Okay, so parent wants to lend money to child. Okay, child wants to buy a house, wants to start a business, whatever. Mom and dad have some decent money in this brokerage account, what have you. They want to lend it to child, and there's maybe an asset. Let's say the kid wants to buy a house. There's maybe an asset against it. Parents have one of two choices. They could, assuming they want to help the child out. I mean, that's a big assumption here. But we do run into, I mean, this is something that happens a lot now. We have wealthy parents who have benefited from the stock market over the last 30 years, and their kids who are in their 20s, 30s, what have you, are coming up in a totally different environment. And the parents see the price of housing and all of this other stuff, and they want to figure out how to help, right? So I've had, there's a couple ways to go about that. If let's say you want to give your kid $200,000 for a down payment on their house, and you have a portfolio that's appreciated, you could sell $200,000 worth of your investments, and then one, you'll pay taxes, assuming you have gains, and two, you'll have $200,000 that's not invested. Instead, what you could do is you could borrow the $200,000 against your portfolio, lend it to your child, and still have your $200,000 invested, not pay any of the taxes on said $200,000, and draw up, have a lawyer put together a note between you and your child to make sure that there's legal terms to what's borrowed. And there's other reasons to do it, but I just, all I'm trying to say is I don't want to come across like this is the worst thing to do. There are absolutely really good times
I hope
to
I
do
wasn't
this.
Implying that. It comes down to like you're measuring three variables. One is, what is the likelihood that this asset is going to continue to appreciate? That's an important variable, which is impossible to predict. Like in the case of the Monet painting, I would guess it's pretty good chance that
I think that's where diversification really helps.
True. So anyway, you got that variable. The second variable is what's the interest rate of the loan? Almost all the time they're variable, but not always. Sometimes they're fixed. And the third variable is what is your tax rate? And you just have to measure all that.
Right.
And see, okay, where do I come out ahead? What's the best solution? And that's where a planner can be helpful. Not necessarily an accountant. I did find it interesting that in that club of rich people in that scene, the person that was providing the financial advice was the accountant, not a financial advisor. So I take offense to that, by the way, show writers.
It is, I'll say this, for like the majority of the new clients that we onboard, a lot of times that conversation starts with, I want somebody to help save me taxes.
Yeah, exactly. Yeah, everybody cares about taxes. It's because taxes are very complicated.
And they're very, like, they just don't like seeing the taxes come out of their paycheck.
Oh,
It's just it's like a hot button for people. And
yeah, for sure.
So you have people that can make, I mean, I do think it's ironic. You have people that can make all sorts of money with the productive things they can do that'll spend, umpteen hours of time trying to save a few bucks of tax. I think sometimes, I mean, I'm all here for saving tax, but there's something to be said for growing your income, right?
Yeah. All right. So in that same scene, there was a reference to something called a 1031 transfer. It was a line thrown away, meant to sound like, oh, it's complex finance talk. This is for rich people. So let's talk about 1031 transfers, what they are. I do have an anecdote. I have a client that's doing a 1031 transfer right now as we speak. Not a high net worth investor. These transfers are specific to real estate investors. So if you're a real estate investor, you've probably heard of the tax code. What is it? Section 1031 of the tax code, which that's where the name comes from. All these things like 401k, 1031, 1035, they're all named after sections of the tax code. So let's talk a little bit about 1031 transfers. It actually ties into this whole concept of buy, borrow, die. And one of the assets that most people use most often to deploy leverage is real estate. So what happens when you want to sell some real estate? It has to be an investment real estate because there's a $250,000 per person.
When you're selling a personal residence, a lot of times you don't owe taxes, or you owe a lot less taxes.
The reason why is it's not because the IRS says there's no capital gain. It's they give you a $250,000 per person exclusion on the long-term capital gain of a primary residence.
So if you're married filing joint and you sell your house for a $600,000 gain, for example, $500,000 of it is not taxed because it's under the exemption. The next $100,000
is taxed.
This is why it's important, by the way, especially as houses become more expensive. expensive. It's a little easier these days to get $500,000 of appreciation. So you want to make sure you save your receipts on personal residence.
But we digress.
Yeah, sure.
So the concept of a 1031 transfer is really meant for real estate investments. And the idea is that you simply want to trade one property for another. You don't really want to realize the gains. You just want to transfer your...
You want to sell one without paying the tax on it.
Bingo. And it's a kick the can down the road strategy, which is perfect for buy, borrow, or die. Because if your intent is to die with real estate, which you have some strong opinions on, I want you to share, then why not? Why not do the 1031 transfer? It's rather complex. I don't want to get into the mechanics of it all, but it entails, there's a tight time frame. The IRS gives you a tight time frame. I believe it's around 180 days. And you have to use what's called a qualified intermediary.
Right.
You essentially cannot touch the money.
You can't touch the money.
You basically have to have this intermediary handle everything for you. And there's also this concept of boot, because a lot of times properties are of not equal value. When's the last time you've...
Yeah, if you're buying a property that's more expensive than the one you're selling, then you're probably okay.
Yes.
But if you buy one that's less expensive, you might have some tax.
Yeah, you're going to get, and it's called boot. That is, I don't know why they call it that, but maybe you know.
Who knows?
But that's basically your portion of the cash that you have to realize. That's your portion of the gains that you have to realize you receive as cash or some other, some other type of security or
it's the gain
asset.
You didn't defer into the new purchase.
Exactly. So 1031 transfers are something anybody can use. They're complex to navigate. You really want to use a real estate attorney, I would suggest, or some sort of accountant that specializes in this process, because they're easy to mess up. But it's accessible to everyone.
Well, I think this one more so even than the last one is accessible to people, because when you have, like, thinking about borrowing against your appreciated portfolio, you kind of have to have the portfolio first.
Yes.
To borrow against it. But in this case, you can go buy a rental property with very little money down, right? You can, unlike a portfolio, I can't go to Schwab and say, hey, I have $100,000, give me $400,000 of portfolio, right? But I can go to a bank and say, hey, I have $100,000, I want to buy this $400,000 property, lend me the other $300,000. And so it's kind of, I think real estate's popular because, one, it's got a lot of tax benefits. You can depreciate.
To my knowledge, it's the only asset that appreciates while you can depreciate.
Right. It's an asset that you can depreciate on your taxes that appreciates in value. And what that does, and the reason why that's so relevant to what we're talking about today, is that embeds a larger gain. Like, a lot of times, if you see somebody that's owned real estate for years and years and years, their cost basis is next to zero.
Exactly.
And so if the building or the property is worth $1 million, it's $1 million of gain.
And you can depreciate all the way to the land value. You can't depreciate land.
Sure. But the point is, they've got a big amount of gain in these properties.
Yes.
And so, of course, nobody wants to pay taxes. And if you pass away with the property, that gain evaporates, right?
Yes.
So what do? You own it till you die. But that's kind of easier said than done, right? Because, like, let's say you have 10 properties, 20 properties, 40 properties, 60 properties. You can hire a property manager, but there's always some level of, like, involvement that you have to have.
Yes.
And you and I have dealt with 80-year-olds, 90-year-old clients where they need help just to take care of kind of what they have going on, let alone managing a bunch of properties.
Yeah, so, and a lot of them go into it with this belief that, Junior will help me take care of it. And Junior gets to that point, he's up to the plate, and he says, this is a hassle, it's a headache, I don't want to deal with it. Yeah.
Yeah, so I think that in concept, the idea of building this big rental portfolio of a bunch of real estate assets with a big deferred capital gain, owning them until the end of your natural life, let's say in your 90s or whatever, it kind of sounds good in a textbook, but it's highly impractical in the real world. Now, there are some workarounds for this. So, like, of course, you can hire a property management company that won't get you completely out of it, but there's some value in that. In the wealth management space, this is where we go from, again, available to not so wealthy investors versus not available. if you have more than $5 million of investment assets, you can actually flip those properties in something called a DST, Delaware Statutory Trust. And it's essentially a real estate portfolio that's managed by a big private real estate firm. And they will take your properties, you will sell your properties, exchange the money into their fund, and now you own a diversified portfolio of real estate managed by Blackstone, Ares, one of these big firms, and you don't have to touch it, and you don't pay the capital gains. So there are some workarounds if you have enough money, and that's where this goes back.
You also lose the choice, the liquidity choice when you
lose
use
liquidity,
those.
you pay higher fees. I mean, there's like plenty of downsides, but if you're 80 years old and you've got a real estate portfolio worth millions of dollars,
yes,
and you're deciding between, do I sell this and pay a bunch of taxes, or do I try to get it into something more diversified? I would still argue maybe
I don't even think
liquid.
Diversification is the issue. I think they're more concerned about just the burden of it all.
Yeah, when I say more diversified, I don't mean, I guess less
of a hassle.
Less of a hassle. They don't have to do anything.
Yeah, so but 1031 transfers at the end of the day, accessible to everyone. This is not necessarily a rich people tactic, but rich people tend to own real estate, so they use it a lot.
But I guess kind of back to my point, and I don't want to say this stuff isn't accessible to folks that don't have a lot of money, but it does become a lot less practical.
Oh, yeah.
If you go at, you have $1 million, $2 million, $3 million in a few properties, and you're trying to manage them into your 80s so that you can avoid capital gains on them. I mean, it kind of is one of these situations where we say in wealth management, the tax tail is wagging the dog.
Yes.
And sometimes, I'd say a lot of times, we try to get people to think a little bit more about their purpose first and taxes second.
Yeah, because we don't need to get into that. I was going to add something, but we got to move on to the next topic, which is the third one that we wanted to discuss, which is this idea of embezzlement, which we strongly discourage. Embezzlement is the act of essentially skimming money illegally.
Sure.
So let's say, well, in this case, Josh, the character played by Oscar Isaac, is skimming some money. So he's creating fake invoices because he's signing off as GM on these invoices, and any invoice below $5,000 doesn't require any approval other than his. So he's creating all these invoices
for $4,999.
The show writers, nobody is this stupid. All right, this guy, I'm sitting here thinking, how is he a GM and he's this stupid? Can you guess what the invoices were priced at?
$4,999.
Really? You couldn't come up with vary it a little bit just so it's not so suspicious. But anyway,
this is like $10,000 checks deposited to a financial. It's just $9,999.
But the concept of embezzlement is you're just trying to skim.
Yeah, you're stealing money.
You're literally stealing money.
It's a very simple concept.
Yes. Now, the reason why I bring that up, because embezzlement, the idea of embezzlement comes up multiple times throughout the show, both at this low level and then also at the higher level, because what you learn later on is that the owner of the whole enterprise, she's not necessarily the most ethical either.
Because
so
that's how they got rich, right?
Yeah, you'll have to watch the show to see how it ends, but it doesn't end great, But what I took notice of, though, is, and this is something we run into a lot in real life, is that the actor Josh has a joint tenant account with his elderly mom because he's viewed in the family as this professional that has his act together. He's got this expensive real estate in California. He manages this whole entire enterprise. So surely he must have his ducks in a row. And as we learn, that's not necessarily the case. And, lo and behold, he's been taking money out of his mom's account to the point where his mom, I don't know if I'm giving away the story here, but we later learned that his mom is dead. And he keeps that account open, and he's still using it. He's still channeling.
You broke the rule. We can't. Spoiler alert.
Well, that's not really a big spoiler.
Okay.
It's not a surprise. You kind of. You don't even see the mom. She's not even in the show. You don't hear her or anything like that. She's just kind of like this off the screen character. But
is she supposed to be very wealthy or something?
No. I think if I recall right, They're Cuban refugees.
Oh gosh.
So the mom is a Cuban refugee. My guess is if I were to speculate here, the money that she was receiving is probably most like Social Security and things like that. But anyway, we don't need to get onto that.
So he's a joint owner on her bank account.
Yes.
So I guess the point you're trying to make here is that what's the right way if you are a parent to have your child help you with your finances?
Exactly. And I have seen this a couple times. I actually just ran into it on Friday. I was meeting with one of my elderly clients, and come to find out, the daughter wants to help mom. And by the way, this is a legitimate thing. I don't think there's anything happening. I think they just don't know. This person has a power of attorney document. It's clear. I helped them. I didn't do it. I referred them to the attorney that created it. But they still went into the bank and talked to the banker, and they said to the banker, hey, I want to help mom manage her bills. So what does the banker do?
Put her on a joint account.
Puts her on the joint account. Automatically, and I told this client this, automatically that account, whatever money's in that account, in this case it was a substantial amount, becomes equal property of the daughter.
Yeah, it's literally considered a gift.
Yes.
That half of that account is considered a gift when that account goes to joint. And I think what's really different about this is when you are somebody's power of attorney. So backing up, okay, this is normal. Parents age.
Yes.
You normally have somebody in between called the sandwich generation. That's basically between their elderly parents and their kids that are now growing up. And these people end up taking on a lot of responsibility for kind of everybody. And there are ways, legal ways, to help your elderly parents or anybody really in your group, in your people, your network, handle their stuff. And these are called powers of attorney. If you are the power of attorney over finances, you can act on behalf of that person. You're not acting as a friend of that person. You are acting as that person.
Yeah.
Under that power of attorney. There's power of attorneys for finances. There's power of attorney for healthcare. So that is pretty fundamentally different than being added as a joint owner. Because now you're not acting as that other person. You're acting as yourself, who's half owner of that account.
And there's also one other detail is when you're acting as a power of attorney, you're acting as a fiduciary.
Well, and that was what I was getting to, which is that as a power of attorney, you have a fiduciary responsibility to the best interests of the person you are representing. The idea is if you are them, then you would make decisions that they would make for themselves, right? But when you're a joint owner, you aren't looked at as them. You aren't looked at as their fiduciary. You are looked at as a joint owner on that pile of money.
Yeah, and it's equally yours. So you can drain the whole account. And there's
no
anybody who's
fiduciary liability there,
yeah.
right? Like versus if you were, in theory, if you had a power of attorney that stole all the money from mom and that wasn't in mom's best interest, and there were siblings that got that were disadvantaged because of that, there are going to be lawsuits.
Yes.
But a joint account, it's their money to take.
So the proper structure. So if you have an elderly parent and you want to keep everything in the family copacetic, the proper structure, if you're going to help mom or dad with the money, is to have mom or dad continue to be listed as the owner of that asset. Also, too, in the context of buy, borrow, die, if you put yourself as joint owner,
you lose the step up.
50% of the step up you lose. So
because your portion doesn't get a step up when that person passes away.
Generally speaking, you should never put yourself as joint owner on one of your parents' accounts just so you can help them pay their bills.
Right. There's other ways to do it.
It's just a bad idea.
There's view access. There's trading authority. Yep. I mean, each institution will have their own systems to whether you can just see the account, you can make money movement through the account, or whether you have full power of attorney and can do anything and everything that the account owner can do.
Yeah. I'm not saying it's unethical, but it certainly raises eyebrows when people do this. It's like, okay, well, did you do this out of ignorance or did you do this because you know what you're doing? Right. And you're trying to kind of drain this account like the character did in the show. He was obviously using that money for himself to enrich himself, and it was his mom's money. But he also did this, and this is where it kind of, I'm like, come on, really, show writers, you got to think of a better way than this. He used that to channel the embezzled funds into. But here's the thing. His name was still on the account. How does that dodge any sort of legal suspicion?
It's very obvious.
Yeah, it's very obvious. So it actually backfired, but I think we've touched on the three topics I wanted to hit on.
The only other thing I was going to say about the power of attorney, and kind of to your point, they did assume he was the one that was, I think they did something right, which was that you don't want to just blindly make somebody power of attorney over finances and healthcare. A lot of times we will see families that have maybe different ones for each. Maybe you've got a son that's a doctor and another son that's a financial advisor. I mean, that's a pretty cut and dry situation, but you get the point. Everybody's going to have different skill sets, and it is important to have multiple people involved in this process because I think it increases the transparency and the trust, right? The more opaque. Like a lot of times estate planning, especially, and like if you have some level of wealth and you pass away and you've got multiple people that are going to inherit from that, you want transparency because the less transparency is, the more distrust there can be and the more issues can arise.
Yes. Now, I do want to kind of touch on, because we got a few extra minutes here, I want to touch on this whole notion of holding companies because that's really what he should have set up as a
now you're going to teach people how to do this?
No, No. So the concept of shell companies comes up in the show, and I don't know if people really know what a shell company is. So a shell company, these are not necessarily illegal entities. Fortune 500 companies use them all the time.
Special purpose vehicles, right?
Yeah, like for example, you mentioned the SPAC, Special Purpose Acquisition Company. This was all the rage prior to 2024 when regulation kind of took a lot of the.
Well, these SPACs get really popular when markets are really frothy. Let's be real.
Well, but also too that regulations were passed in 2024 that took a lot of the benefit out of them. It was these were used as a way. We call it like a cheap and easy way to pursue an IPO. I'm not going to get into to SPACs and how they operate. You can look it up.
Create a publicly traded company, load it with cash, go have it buy a private company. Now that private company is public, no IPO process.
Bingo.
Right.
There you go. Yeah. So, but that's not the way I've read it. I'm not gonna get into it, but the way I've read it, it's not that easy anymore post 2024.
Sure. Okay.
So, but that's an example of a shell company. Shell companies are used for all sorts of legitimate purposes, like holding companies. You mentioned raising capital, asset protection. So you can put, like, for example, let's say we own this building, and we would just put our building into a separate LLC. And pay this LLC rent. And in that case, it would just serve as a shell company.
Shifts the liability from the core business.
Shell companies are also used for a lot of illegitimate purposes too.
Like hiding money.
Yeah, like hiding money. So you can layer money. So here would be an example. Let's say
this is like Enron. Like Andy Fastow.
Yeah, but talk about Andy Fastow.
Oh, well, I think he's on his, I don't know if I would call it an apology tour. He goes and does, you can pay Andy Fastow to come speak.
Apologize for money.
He does talks on business ethics, believe it or not.
Which he charges for, by the way.
Yeah, so, no, we had an interesting situation a few years ago at our financial planning. Actually, this is a good time to plug the Financial Planning Association All Ohio Conference,
yes,
which is coming up next week.
Yeah.
So
very
next
excited.
week, the both of us will be in Columbus, Ohio, for the Financial Planning Association's All Ohio Conference. It's a big conference that's been going on for several years now. Big budget. There's 400 advisors that show up, lots of sponsors, and we at the Money Alchemist Podcast will be the presenting podcast sponsor. So we are hoping to present live. Well, we're hoping to record live and bring out some clips where we get a chance to talk to some of the movers and shakers in the industry and debrief some of the things we talked about.
Yeah.
But that conference, same conference, 2 years ago, Andy Fastow talked, and I'm still trying to get my head around really what he was trying to say in this presentation, because he talks a lot about how what he did. To your point, shell companies aren't illegal. These things aren't. You can technically, his job was about trying to find the most effective legal way to basically
to dodge taxes,
right? Yeah. And so his whole presentation, he kind of talks about how he did nothing illegal because it was all within the rules and he was just really good at his job. And I guess that he believed that so heavily. This is again how he frames it in his presentation. But even when he went to jail, like he literally shows in his presentation the picture of him getting handcuffed and walked into, taken to jail. And he says even going to jail, he felt like I didn't do anything wrong. And then I guess he's Jewish, and he read the Talmud, which is essentially a rule book of like different situations that had happened, and then what.
It's like Jewish legal precedent.
Yeah, exactly.
Yeah.
And basically, there's like hundreds of rules in this, and one rule says that even if something else isn't listed in the rules, if it's done in bad spirit, it's against the rules.
Yes.
And I guess Andy Fastow had this like moment of this epiphany moment where he decides, yes, even though everything that I did was right by the letter of the law, because my intentions were bad, it was bad. And I don't know how I feel about that.
Yeah, well, I think he was just out there throwing, sugar powder over all his misgivings of the past. But I enjoyed his presentation. But he was an expert at using shell companies, and shell companies are these like empty companies.
Yeah, there's some conflict of interest in the parent company owning this. So Enron traded like energy back and forth. And so they had all sorts of conflicts in owning pipelines and things like that. Yes. And so they would just create other companies that didn't look like them that were going to buy it instead, right? And
yeah, and it was a way of obscuring ownership, which is more difficult to do now because the IRS has a rule where you have to disclose beneficial ownership. So you can't just have your attorney act as the agent on the company and then hide behind the client attorney privilege, which a lot of people would do. But there's also they can be used to avoid sanctions. They can be used for corruption and bribery. Like there's some legit bad stuff shell companies are used for. So that part of the show is actually pretty accurate. That this main character, the owner, was utilizing all these shell companies, but she was also under investigation from supposedly the Korean authorities or Japanese authorities. I can't remember. This is what was confusing about the show is that I think there was Japanese heritage mixed in with Korean heritage, and I didn't know which one we were dealing with, but I'm pretty sure it was mostly South Korean. The South Korean authorities that were kind of searching in her business operations. So, there was often talk about shell companies. There's one other thing I wanted to talk about real quick because it was important to the plot, but it kind of really fell apart. And the character, what was her name? Ashley Miller, played by Kaylee Spaney, wasn't able to get health insurance. So she is an employee of this big company, which obviously was getting massive amounts of funding. Per one episode, it was like $50 million from this person. And supposedly the executives all had health insurance, but the rank and file, which she was a part of, was not. And so she got herself into a position where she had to leverage basically blackmailed her way into a promotion in order to secure health insurance so she could get an operation done that she needed done. In reality, that cannot happen. So whenever you have group health insurance for your company, you can't discriminate between highly compensated employees and the rank and file. You have to basically give the same thing to everyone. So there was a little bit of a plot hole there. You did bring up earlier when we were talking about this a caveat to that, and that'd be like, well, what if she was a 1099 contractor? The reason why I don't think that's realistic in this case is because when you're a 1099 contractor, you can't tell someone when to be and where to be and what time to be there.
There's rules on who's a W-2 and not outside of do you decide to pay them a W-2.
Yes.
Now, I think one of the core issues that you're kind of getting at is that there are certain benefits where you can, and it's literally called discriminate versus not discriminate. So some benefits like deferred compensation plans, disability plans. There are areas where you definitely can discriminate.
Yes, but health insurance isn't one.
Health insurance is not one. So 401k, health insurance, pensions, things like that, you have to, there are actual, like the Department of Labor regulates these things, and there are tests that have to be performed normally annually by some kind of actuary to determine, are you giving enough benefits to the rank and file relative to the ones at the top?
That's right.
And if you're not, then it's a big problem.
Yeah, so a little bit of a plot hole there. I'm willing to forgive it, but the show writers obviously consulted something that was inaccurate.
That's okay. They're not financial planners. That's why we're here.
Yeah, they need to hire me. They need to hire me and you.
I don't have time.
Pay us. Oh my gosh, no, they would pay us a lot of money. We would find the time for it.
That.
Yeah, just consult. So if you're one of these show writers, please consult with us. Our information is in the show notes, and would be happy to trade sound information for, of course, for a reasonable fee. So let's get into
I've set up a shell company to receive all the payments.
Yeah. But for the right reasons, right? Not for tax evasion. All right, let's get into the tip of the day. So, we come up with these tips, usually like 2 or 3 before the show, and then we all vote on them. So today's vote actually surprised.
I was the minority vote.
Yeah, that's right. So basically, Brent, myself, and our producer, Nick. So we all basically are recommending Smart Wool socks. And if you've never bought Smart Wool socks before, you are missing out. I run cold all the time, even during the summertime. I will have cold feet. I don't know what it is, but my feet are just...
They get your heart checked out.
No, my heart's fine. I do get my heart checked out. It's just something I've always had. My hands are never cold. It's just my feet generally.
Interesting.
So anyway, Smart Wool socks are some of my favorite. We give these to each other during Christmas. It's literally like, the joke is, you don't give your kids socks and underwear, but we get these Smart Wool socks and we're greedy about them. My wife will literally steal these socks out of my drawer and she just claims them. But don't just buy them anywhere. We were talking about where is the best place to buy these socks. The best place is actually Sierra Trading Post. We looked at several. We looked at Amazon. We looked at, what was that other? You said it was like for
REI.
REI. It was for
No, we're not going to get into it. But
you said it was for hipsters.
The bottom line is that apparently these Smart Wool socks are really comfortable. I do not have Smart Wool socks, so this is
a good tip for you. Yeah, so Sierra Trading Post has them cheaper than anywhere else. They're not like fruit of the loom price.
I mean, these are like $15 for a pair of socks.
Yes, but I've had a pair of these for
I buy like 6 pairs of socks for $15 at Costco.
Yeah, but these, I'm telling you, man, they're worth it.
Right.
And you will have these same socks for years. Now, they don't last forever.
Buy it twice, right?
Yeah, they're high quality. Definitely go and buy them. So that concludes our tip of the week, Smart Wool socks. Go out and get them now while they still last at Sierra Trading Post. So, I appreciate everybody for sticking with us in this episode of the Money Alchemist.
Next week, we're going to be at the All-Ohio Conference in Columbus.
You plugged on that briefly. So the next few podcasts we'll be producing will be definitely a different format. So we've got a whole different system there. We're taking a remote.
Taking the show on the road.
Taking the show on the road. So we're using all new equipment. So it'll be interesting. I'm curious to see if if it's going to be a better or worse experience. But I think,
look, our plan next week is that at the conference, there's multiple sessions. We talk about how money works. Some of the most leading edge people in the money space will be there to talk to us about their respective expertise, and we want to be able to debrief some of that and put it in layman's terms and share it with everybody. So,
yep, looking forward to that. So we'll catch you next episode, which actually is going to be released sooner than 2 weeks. So
great, thanks, Ben.
Yep, thank you. Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.